We're living through the loudest boom of our lifetime, markets climbing like rockets, real estate inflated to the ceiling, debt stacked into the sky. On the surface, it feels like prosperity. Yet, behind that shine is the same silent architecture that stood right before history's two most violent collapses. In 1929, America believed it had outsmarted downturns forever. In 2008, families trusted that housing could never fall everywhere at once. And now, in 2025, we're floating inside a bubble so enormous it makes both eras look small, and somehow, we've convinced ourselves it's normal. Here's the part nobody wants to admit: history isn't random. It's a machine. And the conditions that detonated 1929 and 2008 aren't echoing today. They're mirroring today perfectly. Same leverage, same psychology, same delusion that this time is different. This film isn't a prediction. It isn't doomed for entertainment. It's a forensic reading of a pattern that has only appeared twice before, and each time, it ended with the world on its knees. And that pattern now points to one conclusion. Between late 2026 and early 2027, the system breaks harder, deeper, and faster than anything modern markets have ever seen. You think the system protects you. It doesn't. For 15 years, the American financial system has conditioned investors like test subjects in a long-running behavioral experiment. Every time the market trembled, every correction, every panic, every hint of danger, the Federal Reserve stepped in with the same reassuring reflex. 0% interest rates, waves of liquidity, emergency stimulus packages, bailouts disguised as stabilization. The message became instinct. Don't worry. Buy the dip. The Fed will catch you. From 2008 through 2022, the Fed didn't just support markets, it flooded them. More than $8 trillion was pumped directly into the veins of the financial system, rewriting the psychology of an entire generation of investors. What once felt risky began to feel guaranteed. Volatility felt temporary. Downturns felt like discounts. Losses felt reversible. But here's the twist, the part almost nobody has internalized. Those days are over. The Fed is now out of ammunition, and the playbook that saved the system in 2008 and again in 2020 has been spent. Interest rates are already elevated. Federal debt is already stretched beyond historic thresholds. The Fed's balance sheet is already swollen to extremes. And inflation, the one threat the Fed fears more than recession, has already scorched the political landscape. The tools that rescued the last crises are the exact tools the Fed can't freely use now. Cut rates aggressively, inflation roars back, print trillions more. The dollar weakens, prices spike, and political pressure erupts. Push the balance sheet higher. Confidence in the Fed's control falters. Investors still cling to the belief that the Fed sits between them and disaster, a guardian, a buffer, a net. But the truth is far darker. The Fed is no longer standing in front of the crash. It's standing behind the public, cornered, exhausted, with nothing left to offer when the next shock arrives. The system didn't remove risk, it only delayed it. And now that delay has run out. Every historic collapse begins with a strange calm, a quiet phase where the bubble grows so massive, so omnipresent, that people stop recognizing it as a bubble at all. It becomes the environment, the air, the new normal. And that's exactly where we stand in January 2025. Look at the core of American life housing. The median home price now sits at $420,000, while the median household earns just $75,000. That's a price-to-income ratio of 5.6 to 1, nearly double the historically sustainable 3 to 1. Homes are 87% overvalued relative to incomes. In 2006, at the peak of the housing mania that triggered the 2008 crash, the ratio hit 5.0. Today, we're not just repeating that peak, we've surpassed it. But the real story goes deeper than housing. Corporate America is burdened with $13.5 trillion in non-financial debt, 72% of GDP, far higher than the levels that preceded 2008. The federal government owes $36 trillion, equal to 120% of GDP, with interest payments closing in on $1 trillion a year. Households carry more than $17 trillion in consumer debt, credit cards, autos, student loans, add it all together. And the UCA's financial system is sitting on over $90 trillion of combined government, corporate, household, and financial sector debt, more than 320% of GDP. Never before in American history have all sectors, government, corporations, consumers, financial institutions been this leveraged at the same time. This isn't one bubble. It isn't two bubbles. It is the everything bubble inflated by a decade and a half of near zero rates and trillions of dollars in artificial liquidity. And here's the most dangerous part: a system stretched this thin doesn't require a massive shock to break. It needs only a spark, a trigger, something small that forces selling, exposes leverage, or cracks the illusion of stability. The bubble is already built. The pressure is already there. Now the cycle waits for the moment when the first fracture appears, because once it does, history tells us what follows next is not gradual, but violent. Every major crash arrives wearing the same mask: chaos. You see traders shouting, headlines screaming, markets falling as if gravity suddenly doubled. But if you peel back the noise, you find something colder underneath. Crashes aren't emotional events. They only look that way from the outside. At their core, they're mechanical, a rigid script driven not by panic, but by math, by leverage, by liquidity, and by the exact moment those two finally collide. We saw this mechanism run with ruthless precision in 1929. It ran again in 2008, and the same gears are turning quietly beneath 2025, waiting for pressure to meet a spark. The cycle always begins with euphoria, the warm glow that blinds everyone. Prices disconnect from reality, but nobody cares because everything is rising. People stop asking why and start assuming it will continue. In 1929, they called it a permanently high plateau. In 2008, it was the belief that housing never falls nationally. Every bubble starts with the same intoxicating confidence. Once the crowd is convinced, leverage steps in, borrowing becomes the accelerant. Margin, cheap debt, easy credit, all of it multiplies gains on the way up, making investors feel brilliant. But that same leverage multiplies losses on the way down, turning what could have been a small correction into a structural threat. And then comes the trigger, the part people obsess over, even though it barely matters. A bank fails, a corporation defaults, a geopolitical shock rattles the surface. But the trigger is never the real cause. It's just a spark that touches a fuse already soaked in leverage. What follows is forced liquidation. The moment the machine starts to move on its own. Margin calls hit. Brokers demand more collateral. Investors can't provide it, so they're forced to sell. Funds face redemptions and dump whatever assets they can. Hedge funds unwind positions. Algorithms detect the downward momentum and accelerate it. A slide becomes a plunge. Selling forces more selling. No emotion, just compulsion. As prices fall, lenders grow cautious. Credit begins to seize. Refinancing evaporates. Liquidity dries up. The entire financial bloodstream goes cold. And when credit freezes, the damage spills directly into the real economy. Layoffs rise. Companies close. Foreclosures spike. A financial crisis transforms into an economic collapse because businesses simply cannot function without credit. And then comes the final stage, the quiet part nobody ever talks about. Crashes don't destroy wealth. They transfer it. From the leverage to the liquid, from the panicked to the prepared, from those who rode the bubble into the storm, to those who stepped aside before the break. Every step of this pattern ran in 1929. Every step ran again in 2008. And now, the same machinery hums beneath 2025, invisible to the crowd, but obvious to anyone who has studied how these cycles unfold. Crashes aren't unpredictable tragedies. They are the inevitable result of a machine we keep rebuilding in the exact same way. Most people picture a crash as a lightning strike, a sudden blast, one dramatic moment that sends markets into freefall. But the truth is far more unsettling. The storm doesn't begin with thunder. It begins quietly, long before anyone notices. And in 2025, that storm is already underway. What looks calm on the surface is really three separate crises moving in slow motion beneath our feet. Any one of them could be the spark that ignites the entire cascade, and each one plugs directly into the same hidden mechanism that drove 1929 and 2008. The first trigger reveals itself in the skyline. Walk through any major city and you'll notice it: darkened windows, half-empty towers, entire floors abandoned in the middle of the workday. Office occupancy across the country has collapsed to 40-50% because remote work hollowed out downtown cores. These buildings were financed back when money was cheap, with mortgages locked in around 3%. Now those loans are maturing, and refinancing hits with the brutality of 7-8% rates. The numbers don't adjust, they break. A building that barely survived at 3% becomes mathematically impossible at 7%. And when a property is worth less than the mortgage attached to it, owners stop fighting and walk away. It's not hypothetical, it's already happening. Brookfield, one of the largest real estate owners on earth, surrendered 2 major office towers in Los Angeles in 2023. Not because they were collapsing as a company, but because defaulting was the rational financial choice. And this is only the prologue. More than $2 trillion in commercial mortgages are resetting between 2025 and 2027. If even 30% fail, that's $600 billion in losses, and much of that paper sits on the balance sheets of regional banks. We've already had the preview Silicon Valley Bank in March 2023, Signature Bank days later, First Republic in May 2023. These weren't isolated missteps. They were early fractures, cracks spreading through the foundation. While commercial real estate buckles from the outside, corporate America is rotting from within. Companies that borrowed cheaply in 2020 and 2021 now face refinancing at double or triple the cost. Debt that once felt manageable turns lethal almost overnight. And it only takes one Fortune 500 bankruptcy, one major corporate failure to shatter the illusion that everything is stable. The moment bondholders panic, yields surge. When yields surge, refinancing evaporates. And when refinancing evaporates, companies that depend on rolling over their debt discover the market is gone. This is the exact chain reaction that detonated 2008. Lehman didn't just fall, it exposed the possibility that every other balance sheet might collapse too. Layer onto this the pressure of sovereign debt. Countries like Turkey, Argentina, and Pakistan, loaded with dollar-denominated obligations, sit one shock away from default. And when an emerging market falls, the pain doesn't stay contained. Those losses bleed into European and American banks, the very institutions that extended the loans in the first place. Contagion doesn't observe borders. It spreads. The third trigger is even more unpredictable, and therefore more dangerous, a geopolitical shock. The pandemic proved that markets don't only crash from economic weakness, they crash from uncertainty, from fear, from the simple inability to see what comes next. War, a new pandemic, major terrorism, a contested election. Any event big enough to shake confidence can force investors to sell everything at once. Not because their assets are bad, but because in moments of chaos, people reach for cash. That's exactly what happened in March 2020. It wasn't economic collapse, it was panic-driven liquidation, and that reflex still sits just below the surface. All three triggers, failing commercial real estate, corporate and sovereign defaults, and geopolitical shocks, are not distant possibilities. They're present realities, already unfolding. The unsettling truth is that the next major crash won't come from one singular explosion. It will begin the moment one of these active crises crosses the invisible line where stress becomes rupture, where pressure becomes detonation. And when that line is crossed, the same machine that drove 1929 and 2008 will activate again, gear by gear, phase by phase, until the entire system unwinds. When you place 1929, 2008, and the world of 2025, 2026 side by side, the resemblance is almost uncomfortable. Different eras, different technologies, different players, yet the same outline emerges, like a shadow repeating itself across time. In 1929, stocks had climbed 400% in 5 years and margin debt swelled to 10% of GDP. In 2008, housing prices had doubled and mortgage debt hit 100% of GDP. And now, approaching 2026, every major asset class stocks, real estate, corporate bonds, government debt, consumer credit is stretched to historic extremes simultaneously. It's not a replay of one bubble, it's the fusion of all of them. What makes the parallel even more unsettling is the psychology. In 1929, the phrase permanently high plateau became gospel. In 2008, the mantra was housing never declines nationally. In 2025, the belief is equally seductive. The Fed will always save us. Every generation builds its own myth to justify the boom. Every generation convinces itself that risk has been conquered. And every time, that belief becomes the fuel that feeds the fall. The fragility beneath each era is identical as well. Once a trigger hits a default, a bank collapse. A geopolitical shock selling doesn't stay contained, it accelerates. Liquidation becomes mechanical, not emotional. That was true in 1929. It was true in 2008 and in 2026 with leverage embedded across the entire system. The same chain reaction waits beneath the surface. But what's coming carries differences, and every difference makes the situation worse. The scale is vastly larger, U.S. Market capitalization heading into 2026 is around $50 trillion compared to about $12 trillion in 2008. The speed is faster algorithms, high-frequency trading, and global connectivity can transform a bad day into a historic collapse in minutes. Interdependence is tighter in 2026. No region is isolated. A shock in one market ricochets everywhere. Policy flexibility is limited. Government debt is already at 120% of GDP, leaving little room for the kind of interventions used in prior crises. And the social fabric is thinner. Inequality is now so extreme that a major economic shock doesn't just hurt portfolios, it deepens political fractures already running through society. Put together, it becomes clear that the stage isn't simply set for a crisis. It's locked into place. The same pattern that wrecked 1929 and 2008 has returned, only bigger, faster, and far more tightly wound. History isn't just rhyming, it's circling back with a force amplified by everything we've built since the last collapse. The future rarely arrives all at once. It comes in phases, slow at first, then suddenly, then violently. And the pattern outlined in the reference document is not guesswork. It is the same 5-phase arc that shaped 1929 and 2008 with eerie precision. When conditions rhyme this perfectly, the timeline is less a prediction and more a structural unfolding. We begin in early 2025, the moment we're living in right now. The bubble is fully inflated. Confidence is absolute. Markets sit at all-time highs. Every indicator screams excess. Yet the public mood feels strangely calm, as if the air itself forgot how to sense danger. This is always how the first act looks: too quiet, too steady, too certain. Moving into mid-2025 through early 2026, the script enters its next beat: the initial shock. It doesn't need to be spectacular. A bank failure, a major corporate bankruptcy, a geopolitical flashpoint, anything with enough weight to rattle the illusion. The market drops 10-15% in days. But instead of panic, the instinct is familiar: buy the dip. Investors assume the Fed has things under control. They mistake the first crack for a temporary wobble. Then comes spring, 2026, the most deceptive part of the cycle, the false recovery. Markets rebound. News anchors smile again. Analysts talk about resilience. Social feeds fill with posts insisting the worst is behind us. People relax, unaware that second waves always hit harder. This stage works because it feels so convincing. It gives just enough hope to keep people exposed. By summer into fall 2026, the facade collapses. Defaults accelerate. Credit freezes. Liquidity disappears. What began as a ripple becomes a cascade. Markets plunge not 5%, not 10%, but 50% over 6 to 9 brutal months. Selling becomes mechanical, forced, relentless. This is where the hidden mechanism tightens its grip, leverage unwinds, redemptions surge, and the machine feeds on itself. The descent reaches its darkest point between late 2026 and mid-2027. The panic bottom, unemployment slams into 10%. Banks fail, the government intervenes, confidence evaporates to nothing, and the S&P, which hovered near 6,000 at the peak, can collapse toward 200. The numbers don't just fall, they disintegrate. Eventually, the system stabilizes not through optimism, but exhaustion. By late 2027 through 2030, the slow recovery begins. Stimulus returns. Interest rates fall back to zero. Policymakers rebuild what they can, but the climb is long. The market may not revisit its 2025 highs until the early 2030. Recoveries crawl, crashes leap. This entire sequence can compress or stretch by months, but it never truly changes shape because it isn't emotional. It's structural, and structures don't improvise. They break exactly the way they're built. Below is a cinematic, prophetic, investigative expansion of parts and philosophical ending. Every fact, mechanism, historical detail, and causal chain remains exactly as in your source. No new information is added, only deeper narrative weight, richer imagery, and a more immersive emotional arc. When people think of crashes, they imagine destruction, wealth evaporating, value disappearing, systems crumbling, but history tells a quieter truth. Crashes don't erase wealth, they relocate it. In 1929, money didn't vanish into thin air. It flowed silently, efficiently toward the few who saw the storm early. Those who shorted the market, those who held gold, those who stood apart from the frenzy emerged on the other side with fortunes built on the ruins of the boom. In 2008, the pattern repeated. Wealth didn't die. It migrated. It moved toward those who kept cash, who refused to be swept into the mania, and who had the courage to buy assets at prices others couldn't stomach. Those who prepared early bought homes, stocks, and businesses at generational lows while everyone else was still frozen in fear. And in 2026, the same mechanism will operate again. Not by magic, not by conspiracy, but by structure. Cash holders, gold holders, investors who build short positions, these are the people who will inherit the assets of those who cling to illusions. Those who prepare psychologically, not after the crash, but before it will see opportunities where others see devastation. Those who study the pattern will follow it. Those who deny it will be consumed by it. History never rewards blind optimism. It rewards awareness the calm, cold understanding that cycles rule the financial world more than narratives do. There is no prophecy here, no doom for its own sake. Only cycles older than the Federal Reserve, older than modern markets, older than the comforting stories we invent to pretend we're in control. And the truth inside those cycles is merciless. The system was never designed to protect you. It was designed to reset itself the moment pressure exceeds stability. And the pressure inside 2025 is greater than anything seen in 1929 or 2008. More leverage, more interconnectedness, more belief stacked on top of fragile foundations. We are standing at the edge of what may become the third great unwinding. Not because civilization is collapsing, but because economic engines purge their excess the same way forests burn away dead branches, violently, inevitably, and with a redistribution of power that rewrites futures overnight. Somewhere inside that purge, whether in late 2026, 2027, or the long recovery that follows your future, is being shaped, piece by piece, by the choices you make now. So if this documentary opened a door for you, if it revealed a pattern you hadn't seen before, if it helped you see how the past threads itself through the present, then keep looking deeper. Keep questioning. Keep paying attention to the indicators. Not because fear is useful, but because awareness is. The cycle has already begun its turn. Where you end up when the tide finally shifts will be determined by what you understand before it does. History has already whispered its warning. The rest is whether you choose to hear it.